Welcome back to the Strong Money Podcast. Jacob and I here. We're going to be talking about estate planning changes and the considerations around. I would say the pros, not necessarily the cons, but the considerations around contributing Bitcoin to an irrevocable trust. So we're going to really lay the foundation of the estate planning. Exemption limits that will be changing in 2026. We'll talk through at a baseline why you would want to consider utilizing a irrevocable trust in your financial plan and estate plan. And then we'll move into why we believe that Bitcoin is actually the best asset to hold in an irrevocable trust structure. Obviously, there are some trade-offs like I mentioned, but we'll get into those at another point. This one's really going to be the pros behind it. And then the next video will be the downsides or other considerations you need to think about. So yeah, let's go ahead and dive in.
Let's do it.
Cool. All right. So let's lay the foundation then for everybody. First kind of why. Well, let's talk through actually the estate planning changes coming up in 2026. So back in 2017 with the Tax Cut and Jobs Act, the Trump administration, I should say, actually, doubled the exemption limit for estate size, I guess. So basically, if your estate is below the exemption limit, then it passes completely tax-free onto your heirs. And then if you are above the exemption limits, then the tax quickly accelerates to 40%. 40% tax rate. You can look up the estate tax rates. This is for the federal estate taxes. Just to be clear, there are also state inheritance or estate taxes as well in some states. So you'll want to look up your specific state if you're interested in learning more about that. But this is on the federal side of things. So currently, as it stands, the estate tax exemption limits are at $13.61 million per person. And if you're a married couple, then it's $27.22 million. So like I said, if you were to pass away today, your net worth or your estate value would be at $10 million. Assuming that you had not given away, a lot of money before, or you had not already moved assets out of your estate and used up this limit previously, then your estate would pass to your heirs without incurring any estate taxes. However, let's say you have a $50 million estate value and you were to pass away, you did nothing, no planning around this to avoid estate taxes. The limit would exempt 27.22 of your estate from estate taxes. And then everything above that, like I said, would quickly scale to a 40% estate tax. So we could basically just say 40% of that would be owed in estate taxes. So just with those rough numbers, we're looking at $23 million. 40% of that would be what? $9 million. Yes, you're owing $9 million in taxes. So obviously that's a big thing. It's a big thing to plan around. And where Bitcoin really comes into all of this is, we expect Bitcoin to appreciate significantly over the next 10 to 20 years. We do in the next 12 months as well, but we're thinking long term on this. And so this is where for Bitcoiners specifically, we need to start thinking about this. Even if our net worth is nowhere near those exemption limits right now, we need to start thinking about it right now because it could very well quickly get there. Another note to add on this, the current exemption levels are actually set to sunset and drop down, be cut in half in 2026. So 2025, as of 2024 right now, and then 2025 are really the final years, at least of the current rules, to take advantage of those higher estate tax exemption limits. And then starting in 2026, they will be cut in half and drop back down to wherever it's 5 million plus the CPI adjustment every single year since 2017. So I would imagine it's going to come in around 6 to 7 million per person. So we'll probably be at that, $14 million range, maybe on the high side per couple, 6 to 7, per individual. So, is there anything you feel like I'm missing there? We didn't want to go into this too deep, but we wanted to kind of lay the foundation before we start to jump into irrevocable trust. You feel like that does a good job of talking about it at a high level.
Yeah, I think the only thing to add is just um, that this decrease, while it is scheduled to happen right now, especially with Trump being reelected, that it could be that that is reversed and that these current estate tax exemption limits are kept, um, which doesn't change really much of what we're going to talk about. It may change the urgency somewhat, but if you own a significant amount of Bitcoin, it's kind of only a matter of time. It just might be that that time takes a little bit longer to get above those limits. So, but yeah, that drop probably, I would say probably still could happen. But that might be one of the things that they change with the incoming administration.
Yeah. Yeah, good point. So, it could be extended, out another however many years, to where, like you said, that deadline of 2026 no longer exists. But that's the thing with all of this. We really don't know what the future holds. There's a deadline where it's cut in half, right as of right now, and we can kind of make decisions off the information we have. Um, Trump could extend it. Trump could also make it bigger. Who knows? Maybe even make it smaller. I'd be surprised if that happened under a Trump administration. But the point is, in future administrations, even past what we can see right now, this can change at any time. And so, really, you kind of have to make these decisions based off the current information that you have and hedge your bets as best you can with future considerations. A lot of people over the last, since 2017 to now, have been taking advantage of these higher exemption levels, implementing some of these irrevocable trust structures. We won't go into the different types of structures you could use in this conversation, but a lot of people have been, reworking their estate plan to take advantage of these higher levels. And then whether or not they will change, we don't really know. That's a good point. So next, then, let's talk through how to avoid this estate tax, that we're talking about. We're specifically speaking to the irrevocable trust route. Do you want to just talk through kind of what an irrevocable trust is and how it helps somebody avoid this, I would say, tyrannical estate tax?
Yeah, that's one thing you didn't say. They could just remove the estate tax altogether too. Like that would be awesome. Just hey, don't have any of it. But the viability and likelihood of that with a government that's already spending in a deficit is quite low, I would say, even under a favorable administration. Um, and the easiest way to avoid estate taxes is to not have a large estate. I mean, that truly is the simplest way. You don't have a lot of assets. You don't have to pay taxes on them, right? Just to reiterate that first point. But no, to this specific irrevocable trust
I
idea.
think, yeah, I think that's actually good to mention. I'm glad you brought that up. We have a blog on our website speaking through these kind of estate planning rule changes and our thoughts around it. I just want to actually go through that really quickly because I put in multiple scenarios in there that you can read through. But essentially, when we're talking through these planning opportunities, lowering the value of our estate, there's four really main options. Gifting is one. So, I would say gifting underneath the, annual exemption is what I'm speaking to. And then we have the irrevocable trust structures, which is what we're going to talk about today and why Bitcoin is a good fit to contribute to those. Three is obviously donating to your church or charity to get money out of your estate or spending the money. So I just wanted to go through those kind of high level options of how to avoid the estate tax. Spend it down, donate it, gift it, or move it out into another legal entity, basically.
Yeah. And yeah, I suppose that brings up one other good foundational point. This estate tax exemption limit, it's called a lifetime limit. So that's why with some of these things, you're just saying, Mitch, is, hey, we can do things now to lower the value of our estate that may or may not count towards that limit. Because again, the premise is here is that we can do things during our lifetime that will decrease that limit. So if it's 13.6 and then we give $1 million to our kids while we're alive, that's still going to reduce our exemption by that $1 million roughly. I know there's some technical aspects to it, but roughly it'll reduce it by $1 million. So that's kind of the premise here. It's not just like an on death thing that this is counted. It's also during your lifetime that this exemption limit is counted. And so, anyways, like with anything, we could caveat this to the nth degree. But so the irrevocable trust specifically. So we've talked in previous conversations about revocable trusts. So again, a trust is just a separate legal entity from you as an individual. A revocable trust is a separate legal entity that you retain control and ownership of, and so any assets that are within that trust remain within your estate because they remain within your control. An irrevocable trust, on the other hand, is the exact opposite. Still a separate legal entity, but now you basically give away your ability to control and own those assets. And that fundamentally is what it is, and that is why it can be used in the estate tax picture, because what you're doing when you put money into an irrevocable trust is you are now basically using up again that lifetime limit. You're gifting basically assets to this trust, and now you no longer retain control or ownership of those assets. And so that's very important to hit on, because that would be one really good reason why you probably don't want to put all of your assets into an irrevocable trust, because if you no longer have control, you no longer have ownership, and furthermore, you really can't benefit from that trust, although there is some ways around it that we might talk about in another podcast. If those three things are true, well, then you still need assets for your lifetime. You still need to provide for whatever your life needs are, your requirements are for spending and retirement, etc. So when we talk about putting money in there, this truly is once we get into large amounts of investments or net worth, that it becomes applicable, because only in that situation does it make sense to give these away, because in that situation you can give those assets away and still provide for your current and future needs, versus if it's just like, hey, we're at like $10 million dollar net worth right now, or $10 million estate value, and we want to put all 10 million in an irrevocable trust right now to avoid estate taxes. Okay, great. Well, have fun retiring, have fun going work optional, all that sort of stuff. So again, irrevocable trust fundamentally is you relinquishing control, ownership, and really, in general, benefit of any assets that are in that trust. And the reason that we're doing that is to avoid this estate tax, that 40% estate tax that's assessed on anything above currently $27.2 million if you're married. And when we say, relinquish too, it's not like it's just, okay, you give it to this trust and then nobody in your sphere of influence can benefit from it, right? Most of the time they do. Most of the time we put assets into an irrevocable trust so that our children or our grandchildren or our church or our, charity of choice can benefit from it. It's not like they're just going into the ether and just like, all right, well, have fun, trustee, do whatever you want to do with it, right? Like we can say, hey, this is still for the benefit of somebody, people that we love and care about. It's just not for the benefit of us, so to say. So I suppose that point's important too.
Yeah, absolutely. Those are all great points, and I think it really does a good job of laying the groundwork basically for why you would want to utilize an irrevocable trust structure. Just to reiterate, the main point that Jacob was saying is you don't want to put all of your money into this, because this is truly money that you want to avoid the estate tax with and get the money to either a charity usually or your heirs. So, if you were to wait until you passed away for the money to go to your beneficiaries, well, then you are going to you're going to be subject to this estate tax, assuming you didn't utilize one of these structures. So this allows you to say, okay, well, this money is going to be for them anyways, for my kids, for my grandchildren. I'm not going to need it in my lifetime, so why do I need it to be in my control, my ownership during my lifetime, if it's just going to receive a 40% haircut once I pass away? So let's avoid the 40% haircut for the money that's going to go to them anyways, and get it out of my estate now, while the exemption levels are high, or even outside of the exemption levels, you just get it out of your estate in general. So awesome. So let's talk through then. I think one good factor to speak to is the different types of taxation related to irrevocable trusts. So, like a grantor or a non grantor trust, and what the differences are, because the tax treatment of an asset within these trust structures is important for the conversation around why we believe Bitcoin, is the best asset to hold in a structure like this. So, could you just speak to that difference?
For sure. Yeah, so grantor trust, really, at the end of the day, no matter what sort of trust structure that ends up being, the taxation of that trust still remains with you, the individual. So if there's any sort of tax liability due on the assets in that trust, they're going to be taxed at your tax rates, income tax rates, capital gains rates, whatever, depending on what type of income is being produced or what type of capital gain is being produced. That's how it'll be taxed. On the other hand, with a non-grantor trust, the difference here is those will fall under estate tax rates, which similar to estate tax exemption, or the estate tax once your estate passes on, are much more punitive than what our individual income taxes are. And so, pretty much all of these irrevocable trusts do, fall under that non-grantor bucket. Not all of them. Again,
You mean I think you're saying the other way around, right? It'd be grantor trust would
grantor
what
trust.
most of them is
And
what
here,
most of them are usually classified as.
yes, yeah. Sorry, did I say it the other
Yeah,
way?
yeah.
Sorry. Okay. Yeah. Anyways, all I'm getting at here, irrevocable trust, for the most part, but not always, um, will be taxed at the trust tax rates if we put assets in there. And so again, those tax rates are more punitive, and so it's something that we can avoid. So yeah, leading into the Bitcoin conversation, I don't know if there's anything else you wanted to add in there, but leading into that specific piece, that is where one of the reasons where Bitcoin becomes very compelling as an irrevocable asset, irrevocable trust asset.
Yeah. So just to reiterate, because I know, yeah, you said that most of these trusts are typically set up as a non-grantor trust, where it would be the other way around, a grantor trust
Yes.
to help on the tax side of things.
Yes.
Okay, so yeah, so that I think does a pretty good job there of just explaining that subtle difference, because then that plays into, okay, what type of assets would you want to hold within this? So let's just go ahead then. And is there anything else you feel like would be good to just lay the groundwork? The only other thing that comes to mind for me is oh my gosh, I think I just completely lost it actually. The only other thing the only other thing that comes to mind to me is like when we set up a trust for this, deciding either which Bitcoin or what assets in general we should contribute to an irrevocable trust. I don't know if that's necessary to lay the groundwork, but it's just something else that came to mind of like, should we contribute maybe our highest cost Bitcoin, our lowest cost Bitcoin, or should we put in our real estate, or should we put in, our stocks, our equities? When we're thinking about that, I mean, any thoughts you'd like to speak to there, just at a high level? Again, we could go into the weeds pretty far, but that's not the point of this conversation.
Yeah. Yeah. I mean, in general, and while it's not always true, in general, we would like to put in our lowest cost basis. And I guess just a quick refresher, cost basis, that's just the cost at which you acquired an asset, whether that's Bitcoin, real estate, stocks, bonds, otherwise. So if I bought Bitcoin for $100 way back in 2013 or whenever it was trading for that, that would be my cost basis, even though that Bitcoin is worth 90 some and some change today, right? So in general, then what we like to put into these irrevocable trusts is the lower cost basis stuff, because then in effect what we're doing is whatever Bitcoin we retain, under our control and ownership has a higher cost basis. And so the tax implications of if we need to use that or when we need to use that Bitcoin or whatever other asset it is, are less, right? So if we've been buying all the way from $100 up until, $98,000 a couple of days ago, or 99, by saying, all right, we're going to put the $100 basis into the irrevocable trust, retain that stuff that we've been buying. Okay, great. Well, now we go to sell, then we either have a minimal tax impact or maybe no tax impact at all, because that basis is, right around where Bitcoin is trading. So not always, it does, that's like the rule of thumb. That doesn't mean that we always necessarily want to do that. But generally that's better. And that really goes for whether it's irrevocable trust or whether you're giving money away to a charity, just gifting in general. That's kind of what we prefer to do when we're doing that.
Yeah. To say it another way, really the asset with the highest unrealized gains, so that you're avoiding paying any capital gains taxes on the assets that you're putting into a trust, or, to your point, donating to charity or whatever that it looks like. So your assets with the most, embedded gains. And then really, I would say another, from my perspective, another asset or another just clarificate, maybe quality of asset, is your highest appreciation potential assets. Obviously there is the balance of, okay, we need to make sure that our needs are taken care of in our life, our immediate life, in retirement or whatever other goals we want to achieve. But again, you're putting an asset into this trust structure to avoid the 40% estate tax, grow for the long term, and ultimately pass to your kids or grandkids. So if you want to avoid the most tax, put in an asset that's going to, appreciate the most in your mind, so that when it does pass, there's not that massive tax hit on whatever it's grown to. And I laid out again a couple scenarios in the blogs on our website, so you can go check those out. Of, okay, Bitcoin, I use the moon boy math. Well, I say moon boy math. It's really just reality of what's happened. If you use a 25 to 40%, compounded annual growth rate, and you push it out 20, 30 years, things just get absolutely crazy. So I went ahead and ran with it and put in the high numbers just to make it fun. But if that does really happen, which it could, then it makes all of these strategies even more valuable, because we're, as you'll read in the example, I mean, you're avoiding, we even just said 9 million in the short, example we gave earlier. But, if Bitcoin ends up growing like crazy, we're avoiding $50-100 million in taxes, potentially, depending on what happens. And one thing also I do want to mention before we dive into the specific qualities of Bitcoin compared to other assets that you could put into these trust structures, is I could see the estate tax being a way that a future administration kind of attacks Bitcoin, if you will. Because if we, I say we, well, I mean, yeah, we, if Bitcoiners, is what I'm referring to, become the wealthier, group maybe of the United States, because everything works out like we feel that it can, that could be a way that they could attack, us as a whole, is say, okay, well then we'll just drop the estate tax exemption limits way down. There are strategies to get around this, but eventually we're going to get you with a high, estate tax. Or maybe they would just, they wouldn't worry about the estate tax. They would do a wealth tax. I could also see something like that, to where, you have had this asset that has appreciated against the dollar so much that, okay, well now we're going to come and take our fair share, or whatever you want to say. So that's just a thought that I have. If things start to, we get a government, we don't see that happening right now with current administration, but I could see that being an avenue of attack, I guess, against Bitcoiners. in the future if the dollar just continues to die.
And this, I mean, it's not out of the
In
question
spiral.
either from the standpoint of if, you look at tax rates right now on different assets, I mean, pretty much every asset has a different way that it's taxed, right? Because you take like the example of, okay, I can own real estate, I could own stocks or bonds, I could own art, or I could own commodities, right? Kind of four separate assets. Depending on how those assets are used and how you sell them, or the income is realized, those could have four different ways that they are being taxed, to you personally, or in this case, if we're going to do it in irrevocable trust, they are kind of looked at separately. And part of the not problem, but part of the difficulty with Bitcoin right now is, while yes, it falls under some classifications, right? So we've had I think it's, I'm going to get these, I'm probably going to get it backwards, but I think it's the SEC has kind of said it's a commodity, right? And so, okay, maybe it should be taxed like a commodity should be taxed. Well, that's not maybe fully the case sometimes, or fully true, because it's also not fully a commodity either. And so neither here nor there what it's actually classed at today. The premise that I'm getting to is there have been some rulings about what it's classified as, but those rulings, they're trying to kind of fit Bitcoin under an existing bucket, when it could be very likely in the future that they just create a new Bitcoin or a new bucket for Bitcoin and maybe other cryptos in the future that says, hey, this is the specific tax rate for these specific assets. And again, what I'm trying to get at is the groundwork and the premise for that is already there, and that you kind of already have that with different assets you might store your value in right now.
Right. Yeah, absolutely. So, we could see that coming, and this could be one way to avoid that. We'll get into, the reasons why Bitcoin are better than other assets. But another thing that I think may be good to mention, and I keep like losing my train of thought as soon as I go to talk. Today's not a good day for this, I guess. It was the capital gains, the whole capital gains changes that could happen. People want capital gains taxes to be removed on Bitcoin completely. Bitcoin's money. We shouldn't pay capital gains taxes.
Mm-hmm.
So even if that, one point that's, I think good to make here is, even if that happens, they're still going to denominate your estate in USD. So these estate tax exemption limit levels are only modified upwards by CPI, typically. And so, as every Bitcoiner listening to this knows, CPI is a scam, and it's going to go up very, slowly over time. And the kind of the devaluing of the dollar is going to go, much faster. And that makes us believe, okay, Bitcoin's going to appreciate much faster. So the point is, okay, even if we avoid capital gains taxes, they're going to denominate your estate in USD. And so whatever the USD value is of your Bitcoin, that's going to be your estate value, plus whatever else you own. And, they're still going to come after you, I guess, in that way. Even if we get, Bitcoin viewed as legal tender and capital gains taxes removed, and, all the things that we want to happen, basically.
At least until Saylor becomes president, because, every Bitcoiner just super loves Saylor right now. Saylor will come president, and he'll just make the official inflation rate whatever the Bitcoin return for the previous year is. So then we'll be golden. That's all we'll need. Just Bitcoin. All right, yep. Bitcoin goes up. That's the inflation rate. So our or he'll just denominate it in Bitcoin. One of the two.
Yeah,
so.
there we go. Yeah, yeah, that's what'll happen. The day that the IRS denominates your estate value in Bitcoin, that'll be a fun day. I don't know if we'll ever see that, to be honest. Even though we're young, we got a lot of time left here on this earth. Hopefully, Lord willing. I'd be shocked if we saw that in our lifetime, but maybe.
Yeah. You're saying
all right. So, yeah, exactly. So let's get down to, I guess, the meat then of what we wanted to talk about here is, why Bitcoin is almost I won't say the perfect asset, because there are some drawdowns with custody considerations drawbacks, I should say, with custody considerations and other things that we'll get to in a future episode. But when we're just thinking about the different assets that you can hold within an irrevocable trust, Bitcoin is the king. And it's for a lot of the same reasons that Bitcoin's the king otherwise. But we'll just go ahead and dive into them, specifically related to an irrevocable trust. I mean, the other things that you could hold within a trust structure, I mean, it's really, correct me if I'm wrong, but it's pretty much anything, I suppose. But if we're just thinking about the primary assets of real estate, we could hold in there equities, bonds, Bitcoin or other crypto, which, we don't talk about that here. Or a business, a share of a business would be the other thing. Is there any other major kind of asset classes that you would say? I mean, I guess we could say gold and other commodities, but anything else that you would typically, or you maybe have seen held in these trust structures?
Yeah, art and collectibles for sure. Those are a big use value for this sort of stuff. But that's it. That's probably the only other one.
Yeah. Okay. So we'll go through these different qualities of Bitcoin, compare them to, these other assets, and, just explain why we believe Bitcoin is, comes out on top in these different areas. Again, they're on both of all these things that we've talked about and we'll talk about. There are a couple blogs on our website that you can go read. If you prefer reading through it versus listening to us ramble, you can go check that out. So first and foremost, why Bitcoin is the top dog asset to hold in an irrevocable trust, I would say, is tax efficiency. So if we're just looking at comparing Bitcoin to other assets when it comes to tax efficiency, there's a lot of different ways that we could look at it. But when I'm thinking about this, two things come to mind for me. One, there is no forced income event with Bitcoin like there is with other assets. That could go for real estate, that could go for equities, whether you have ETFs, mutual funds, whatever you want to say. There are forced income events that happen, unless you wanted to own a real estate property that didn't have any cash flow, which, I don't know anybody that's signing up for that anytime soon. But there's forced income events, whether that's tenants paying rent or with, on the equity side of things, we have dividends, or, capital gains payouts on ETFs, things like that. So that's where Bitcoin shines because there is no dividends. There's no interest being paid. There's no cash flow that you're taking in with this asset. And so it ends up being a more tax efficient asset to hold within this irrevocable trust structure. And like we said earlier, if it's a grantor trust, which, most of them are, you're on the hook for that tax bill, personally at your gains rates, and you got to pay that through your cash flow, or with another, asset that you have. So when we're thinking about minimizing taxes to us personally with the asset that we put into the trust, Bitcoin takes the cake there from that perspective.
Mm-hmm. Yeah, and it's interesting. You say I don't know who would want to hold real estate without cash flow. I actually think I saw a clip of Michael Saylor talking recently, and he was talking about land banking, and I actually almost exactly is that. You hold a real estate asset that you may or may not have cash flow on. It's not necessary. You get the appreciation value, but basically you own it, mostly free and clear, and then you just take out a line of credit against it, and then you use that as your own personal bank, basically, as your own secured bank. So, anyways, that's another aspect of it, or a different aspect. But yeah, it's pretty incredible when you. And this is a big benefit of Bitcoin in general, right? Like it's not even just under these irrevocable trust structures. You talk about tax efficiency. Yeah, like that's one of the biggest benefits of Bitcoin in general is it doesn't create a taxable event. You get to be, choose, when those taxable events come about. And so, yeah, when we think about, okay, hey, does this work within a long-term, trust structure? Yeah, for sure. Because if the plan is to put the Bitcoin in the trust and then never sell, cool. Then you don't realize any taxes just because there's no taxes to realize. You haven't done anything. When you die or whoever this eventually goes to and they get it, they can deal with whatever taxes might come with, selling that. And I guess maybe that is an important note too, around this whole, what assets to put into an irrevocable trust. And I'll just stick with the trust structure that you want to go to some sort of family heirs, so children, grandchildren. I think it was a pretty recent ruling. I don't know how recent, but it was changed that any assets that you put into an irrevocable trust, they no longer receive a step up in basis at your death. So prior to that, and assets that are outside of an irrevocable trust, when you die, most of the time they'll get what's called a step up in basis, which is basically just back to that example. If you bought Bitcoin at $100 and it's now at $100,000 and you die when it's $100,000, most of the time whoever inherits that Bitcoin would get that step up in basis. So their basis would actually be $100,000. So if they inherited it and then sold it at $102,000, they're only going to realize a $2,000 capital gain event. With the irrevocable trust structure, that no longer happens. So you no longer get that step up in basis. So any assets you put in there, when those are inherited and if they are sold down the road, or if that Bitcoin is sold down the road by the people or by your beneficiaries, they're going to be selling with that original basis that you bought at. So that would be, that's kind of where these guidelines come into play, is like normally you want to put in the stuff that has higher appreciation because that leaves you the lower appreciated at Bitcoin to be able to live off of. But if maybe that taxability or that tax difference doesn't matter to you and you really want to benefit your beneficiaries even more, then you would actually flip that on its head and you put in the higher appreciated or the lower appreciated assets, because your beneficiaries would then not have to realize as large of a capital gain event or a tax event when they went to use it in the future. But neither here nor there. From the tax efficiency standpoint, the premise is that we get to choose, we get to delineate that aspect, and it's not a forced income event for any reason, right? Real estate, you could be forced to sell, if that absolutely happened. With a stock, I mean, can never really be forced to sell per se, but what, are you shaking your head because you don't like eminent domain? Is that what I'm seeing?
Oh, I mean, well, no, I was thinking where we'll go next is property taxes. That's what I was thinking. And it's because I was watching Yellowstone last night with Claire. We were watching the new episode of Yellowstone, and they were talking about how they wouldn't be able to afford the estate tax. So they were going to have to sell their ranch, basically, that's been passed down for generations, 4, 5, 6 generations, something like that. And now they're going to have to sell all the land because they can't afford to pay the tax. They don't have a liquid asset to be able to do it, which is not property tax. I know I said property tax, but that's where property taxes can force you to sell too, because it's like, okay, well, I can't afford the property taxes. I have this maybe family home that's been passed down for generations, but I don't have the cash flow or the liquidity to be able to pay the property tax. So now I got to sell the ranch, sell the land, sell the, the building, the home on it, just because of property taxes. So, that is where I was going to go next, but that's where hearing you say you become a forced seller, basically, of a real estate property, whether it's because of this estate tax piece that we're talking about or property taxes, whatever else. But that's why I'm shaking my head.
And I mean, that's where, this whole, so we have property taxes for real estate. Like, you want to talk about one of the other ways they could, make Bitcoin less favorable. They just have a Bitcoin hodling tax or some, crap like that. Like, it's the same thing. Like, people who own real estate, like they just have an asset. Like, why you have to pay taxes just because you own an asset is, can debate the kind of benefits of that, I suppose. But like that is kind of what we were getting at is,
well,
go ahead.
If we're being honest, it's probably just because of fiat money. Honestly, I mean, when you think about it, it's like, okay, they're holding the real estate as an asset, an investment asset is
Mhm.
what, I know that you still have property taxes on your home, but in a sound money system, the value of your home would get cheaper over time. It wouldn't actually get, more expensive or worth more over time. And so that is probably why they're like, okay, we're debasing the currency. All the real estate values are going up. We'd like to take a piece of that pie. And that's where you get, all of a sudden you get a property tax.
Mhm. Oh yeah. Yeah, same thing. The same reason we have capital gains tax. Except with real estate, you get double
Yeah,
dip
exactly.
because you get capital gains and property taxes. Unless, of course, you 1031 it. I suppose you can avoid that, but different conversation.
Mm, yeah. So, okay, yes. So, yeah, the next place I was going to go was the property tax route. If you're owning a real estate investment within this trust, or outside, like we're talking to, again, what I said before we kind of got into this is Bitcoin's really king for the same reasons it's king outside of an irrevocable trust. But it's just fun to talk through this side of it because this allows us to avoid that 40% haircut, like we're talking about, and still benefit from the apex predator that Bitcoin is. So property taxes was the next thing, but I think we touched on that. It's a the tax piece. It's what it is really it's a leak. It's a leak on the wealth that you're looking to pass on to your kids or your grandkids. And so when we're talking about long-term generational wealth transfer, we want to own an asset that's not bleeding out, leaking out wealth, every single year, and when it gets passed as well. And so when you're owning real estate, like you're saying, we have property taxes, we have capital gains taxes, we have the cash flows, the cash flow that's basically these are all forced taxable events that Bitcoin just doesn't have. Um, I put some other things in the article that I think are good to mention. Bonds, they pay interest. That's a forced income event. Real estate produces cash flow. Oil and gas investments pay royalties. Whatever else you want to own, Bitcoin's going to be the most tax efficient of all of them, no matter what you want to compare it to. I mean, maybe the art and collectibles. Art's not paying dividends last time I checked. So, I mean, maybe you could say they're that it's equally as tax efficient. I don't know.
The art one's interesting too, just because people do get in trouble sometimes, and I think this is where I can't remember a specific case. I read about it a while ago, and it was fascinating. But it was something like this: they put art in an irrevocable trust, and part of like the benefit of assets in an irrevocable trust is you can no longer benefit from them. So what do you do with this art when you can no longer benefit from it, right? Like that's kind of part of the principle. And so if I remember correctly, I wish I should have looked at this more beforehand. But it was something that, along those lines where it's like, okay, well, if the art is still hanging up in your fourth vacation home, like, is that actually, are you getting benefit out of it? Like, is you looking at it getting benefit out of it? So, but anyways, that aside, yes, that does have the same qualities. The difference here is that art it is still it's still an asset, I should say, that is fulfilling a function of money when it shouldn't be, versus just allowing Bitcoin as money to fulfill the function that it should. So, uh, you know,
Yeah.
I guess from a logical perspective, that's where Bitcoin can make more sense, even though the tax efficiency is maybe the same.
Right. Yeah. We're only saying that from a tax efficiency perspective, just to be very, very clear. Um, so cool. Yeah. So oil and gas pays royalties, businesses produce profit or even have a liquidation event if there was an exit, something like that. And, you wouldn't necessarily want a irrevocable trust to own a portion of a business anyways. If because then it's going to have to make decisions, everything like that. Then you have a trustee uh, that would have to be able to make decisions in the business, I guess.
Mhm.
But anyways, that tax efficiency is really, I think, a massive one. And again, this applies to outside the irrevocable trust structures. Next one, and these really, as I look back through this isn't really in any particular order necessarily, but these are all, I would say, equally as valuable. So the next one is low carrying costs. So with Bitcoin, there really is no cost to carry Bitcoin. If you own a real estate property, you may have a property manager, especially if it's going to be in the irrevocable trust, you would definitely have a property manager taking care of that, for you. So that's, again, another leak on your wealth. You are paying to carry that real estate. We mentioned property taxes in the tax efficiency section, but again, this is a carrying cost of real estate. Are the property taxes that you would have to pay on a regular basis.
Yeah.
Even like stocks or ETFs, most people wouldn't own one single stock necessarily. Maybe, but most people would rather own an ETF, something like that, and you're going to have an expense ratio, expense fee that you're going to be paying on that. Again, it's just another cost of carrying that investment that doesn't necessarily apply or doesn't have to apply to Bitcoin.
Yeah, and I know this is probably skipping ahead a little bit. Actually, no, it's the next one. So I'm just going to tie it in right now because it would on the face of it, right? So we compare carrying costs of a stock versus carrying costs of Bitcoin. They're pretty much the same, right? Like I can own Bitcoin outright, and well, you can't really own it in a self custody because you're not custody anymore. But you can have a custody structure where there is theoretically no cost or very minimal cost, which is we'll get more into that maybe in the second episode, the cons section of this episode. But
Yeah.
what I'm getting at here is if we can own Bitcoin in a custody structure that has no or minimal cost, we can do the same thing with stocks. The difference here being the counterparty risk on them. So with Bitcoin, if we own it on chain, we own it through, let's say, some sort of multi-sig or collaborative custody scheme. There really is minimal, especially if it's a pure multi-sig, counterparty risk. And even counterparty risk on a collaborative custody, we talked about that in a previous episode. While there is certainly risk there, it is still minimal versus a stock, which is for the most part, fully custodied asset. I know with the whole GameStop thing, people got a little more weary about actually custodying their own stock certificates, right? But by and large, if people are owning stocks, they're going to do it through a custodian, TD, a Schwab, a Fidelity, or whatever. And so that really is where the difference comes between them, right? And again, what we're trying to make here is it's not like that Bitcoin is necessarily the only or the best in every single area of all of these. I mean, I shouldn't say the only best, right? So stocks and Bitcoin, yes, there's low carrying cost. But stocks, as we talked about before, they have lower tax efficiency, as we're going to talk about next. There's going to be more counterparty risks on a stock. So even though in this specific instance, carrying costs may be the same, what we're trying to get across is that by and large, when you look at a number of factors, that is where Bitcoin begins to come the best. Kind of like how we view Bitcoin as money, right? It's like, yeah, gold and Bitcoin are kind of, especially right now, they're about equally scarce. Yeah, dollars and Bitcoin, they're for general purposes equally divisible, equally portable, especially with digital dollars. And so this is again where it's like, but when we go take a step back and look holistically at each of these things, Bitcoin starts to really shine because it is good at each of them versus every other asset has some sort of detriment along with it. But yeah, just to the carrying cost piece, it's like, yeah, you don't really have much with Bitcoin again because it is such a pure and a simple asset. So makes it very efficient from that standpoint. Makes the trustees' job a little bit easier. Really, all they might need to keep up on is just doing key checks every once in a while as custody changes through the future, making sure that they're doing their due diligence to keep it within a custody structure that makes sense. But it's kind of one of those things that you can set it and leave it for a while.
Right. Yeah, absolutely. I mean, to your point, like you're saying, Bitcoin's either tied for first or first in all of these areas, and so that's where it comes out to be overall first, even if, you can hold a stock. I mean, the only reason you can hold a stock at a custodian and not pay anything is because they're they're lending it out on the back end. Like, that's rehypothecation. Like, that's when you sign up for a brokerage account, you're signing up for them to be able to lend out your securities behind the scenes, and they're making money off of that. So that's the only reason that, you can go to Schwab and hold a stock there and you don't owe a fee. So, obviously there's risks that come along with that people are people are more likely to take on than they would do with Bitcoin. So that's something to think about too. It's not necessarily a cost to you, but it's a potential added risk to you, on the back end. Some other things that I didn't mention with low carrying costs for Bitcoin versus real estate. Real estate, we said property taxes. We're also talking about insurance, legal protection, property management. I mentioned maintenance, required renovations, upgrades, or potential damage, from tenants or natural disasters, which, they may or may not be covered by insurance. Insurance is going to fight basically anything that you try to get paid by them. So that's just more costs that you're throwing into the mix just for simply holding this asset, and not doing anything with it because you want it to benefit your kids in 20 years, your grandkids in 40 years. Real estate just has so many downsides when you really stop and think about this. It's pretty crazy. So, I think
you see the insurance piece just recently. I think it was last week. Anchorwatch is the company. They actually now are backed by Lloyd's of London to provide insurance on Bitcoin holdings up to like $25 million. So I think you have to have it. I haven't looked at it too much yet, but I think you do have to hold it where at the very least they're going to be able to see XPubs, but it might be like a collaborative custody type thing where Anchorwatch, the company, holds a key, and that's kind of how they, check for proof of funds, whatever. But you can pay actually to have an insurance policy on your Bitcoin up to 25 million. So prevent, like loss of keys, someone steals your Bitcoin, whatever, you can actually pay for that. So I know it's an aside for this conversation, but I thought that was really interesting. I'm like, for, as Bitcoin grows, that probably is going to become more and more popular, to do, because it makes all the sense in the world. It's just, again, it's one of those things for custody you have to consider. But you saying insurance just brought that up in my head. So, okay, maybe you got one more carrying cost for Bitcoin. You want to pay for insurance on it.
Well, that's interesting though, because how would you prove that someone stole your Bitcoin? Like, how would you prove that for insurance purposes? Because all you were saying is it moved XPubs. Like, how are you going to prove that? Oh, this is not mine. This wallet's not mine, and it could very easily be yours. Anyways,
that's what we should probably have a conversation
for another day. But
yeah, we should probably talk to Anchorwatch, because I mean, seriously, that was where my head went to. Like, how do you have any sort of proof that, oh yeah, no, this is definitely, I don't control those keys. What are you talking about? That XPub isn't under me. Like, it's great. But, and one other thing real quick before we move on, because I did bring it up, and I think it'd be good if people aren't aware. So, with stock certificates. So again, when you're owning a stock at a custodian, they can kind of do whatever they want with it, for lack of a better word, rehypothecation or otherwise. And so one of the things that, if that's like, hey, that catches your attention, you can actually take at least more control over your stock certificates through a company like ComputerShare. That's basically what happened with GME, is that they ended up, a lot of people who own GME started transferring their certificates to ComputerShare, because then they still are kind of a custodian in a sense, but you really do maintain full control over what happens with your specific shares, your specific certificate. So this rehypothecation specifically can't happen. So, if you're listening to this and you're like, wait, I didn't realize rehypothecation was a thing. Like, there are ways that you can, kind of fight back against that per se. Still not the same thing as self-custody in Bitcoin, but it's at least a step in the better direction from that standpoint.
Yeah. As far as I know, I think you can opt out of it too. You will be defaulted into it if you set up I haven't worked at Schwab in a few years, so it's hard for me to remember exactly, but I think you're defaulted to where you agree to allow them to rehypothecate your assets, but I think you can opt out. I think you can, if I remember right. It's just one of those terms and conditions things that, no one ever reads, and they just check all the boxes and move forward. That's where you're agreeing to that. But I believe you do have to agree to it. They have to get your permission. Cool. So, you hinted to, and I just wanted to talk about this, the custody aspects of holding Bitcoin within an irrevocable trust structure. I mean, when we're talking about the carrying costs, that's where there could be carrying costs to Bitcoin. You don't necessarily need Bitcoin to be held by a qualified custodian if it's in an irrevocable trust, but it's probably the most prudent thing to do, which we'll get into that conversation with the kind of the downsides of Bitcoin and these trust structures. But you don't have to. So you could still, have a pure multi-sig setup where you have, 3 trustees and each one holds a key or something like that. You'd have to be people that you really, really trust. And there's a lot of, trade-offs with that. But I just wanted to mention that because this is where, Bitcoin could have some downsides within the irrevocable trust structure, and this carrying cost, Bitcoin being the best from a carrying cost perspective could change depending on how you decide to have it custody.
Yeah. And even still, even if you have it custody, I think the point there is it's still likely more efficient or better carrying costs than pretty much any other asset.
I'd be shocked. I'd be shocked if you own a single stock. You own Amazon, but again, we're getting into now I own $3 million of or I own $20 million of Tesla stock. It's like, well, in my mind, there's a lot more risks there than owning $20 million of Bitcoin. There's a lot more risks with owning a single stock than owning Bitcoin, which Bitcoiners will understand what we're referring to. Any normie listening to this will be like, what the heck?
Well, unless, of course, you're on MSTR. MSTR is better than Bitcoin, so.
Oh, dear. So
I will be very interested to see how well that ages, and I'm not serious, just for everybody at home saying that. But I am so interested to see how this whole saga plays out.
Yeah. There's just a lot more counterparty risk with a single stock than there is Bitcoin, which is another conversation for a different day. But I would be shocked if someone would custody your Bitcoin and not charge you less than Schwab would to hold your $20 million in Tesla stock. Honestly, Schwab might pay you to custody your $20 million of Tesla stock there, so they can again make money lending it out. Which is a real thing. So, okay. So next one, divisible and highly liquid. This is one that I think is also important here because we're thinking about, passing assets to multiple heirs. If we're passing a big, ranch out in Montana, to go back to the Yellowstone reference, we're passing a real estate building, an apartment building. How are you going to split that for 8 ways between your grandkids? You're not going to be, I mean, you can, but that's not a good, I guess, outcome that you'd like to achieve. What if somebody wants to be bought out? They don't want to own 1/8 of this apartment building and Iowa or wherever it is. You want an asset that is going to be divisible for you and have the liquidity to be able to actually, sell if they wanted to without, jumping through a bunch of hoops like you would with, selling a real estate asset.
Yeah, for sure. And I mean, and that's the thing too, is it's not even like, okay, you own some sort of real estate that it's, has to be split up 8 ways, right? Like the trust, you could just say, well, the trust is going to continue to own this and distribute to beneficiaries along the way, and they'll, have the burden of taxes, whatever. The point here is that still just kind of sucks in a couple ways, mostly because, hey, yeah, what if some of those grandkids, like, what if it would be, nicer just to say, hey, yep, here's your Bitcoin, and you go off and do whatever you want with it. You don't even have to have the trust structure that you're going to get a K1 from every year, whatever it's going to be. You can just, okay,
Mhm.
yep, it was in this trust structure for however many years, and now it can be distributed to you, right? So even outside of like the whole trying to divide it within it, just the ability to, um, you know, just own that thing for your beneficiary to just own that thing after the fact is greater. And of course, maybe you don't want your beneficiaries to outright own it. You would rather the assets stay in the trust. So that, that's a different conversation. But even still, if you want the trust to provide for them in some sense, even if it has to stay within that trust structure, um, take the divisibility out the window and you talk about the liquidity aspect of it, it still gets back to the premise of, okay, really a complex process to sell large amounts of real estate. Who knows if you're really getting the best price, all the transaction costs, all the people that are involved in doing that, et cetera, versus Bitcoin as a 24/7, 365 market that's highly liquid, and can support, hey, yeah, I want to liquidate my, 100 or my $20 million in Bitcoin. Like, okay, cool.
Mhm.
Like you can do it in about 2 minutes, and you're probably hardly even going to move
Yeah.
the market type thing. So it can be done
Mhm.
very quickly, very effectively, and very cost efficiently.
Yeah, absolutely. Yeah, I mean, you have a $50 million apartment complex. Good luck selling that, and I mean, unless you wanted to take a massive haircut on the price, good luck selling that in any short amount of time. I mean, it's just not going to happen. There's only so many people that are willing to own, a $50 million apartment building in middle of nowhere, Nebraska, or whatever, wherever it is, Florida, who knows. It's just that market is, there's a lot less people that are going to be available to sell to at a price that you actually want to realize. And so that's where you mentioned that we're also going to have the attorneys involved, and the real estate agents involved, and everybody else getting their fingers in the pot. With Bitcoin, there's going to be a transaction fee, and that's that.
Mm-hmm.
It's going to be a lot less than the people who are wanting a percentage of the real estate transaction.
Yeah, and even from stock and bond perspective, like those are closer to Bitcoin. It's kind of the same thing as the carrying cost there, and yeah, they're really pretty efficient. Yes, they're fairly highly divisible and they're pretty highly liquid, but it's still just not to the extent that Bitcoin is. Especially like if you own individual stock and it's smaller company stock and you have a sizable amount of it, like sure, you might be able to sell it, but you might move the market a lot. You might have to do it over a chunk of time. But even if you have a large company stock, okay, well, you're still limited to 9 to 5, 5 days throughout the week, not on the weekends, which theoretically shouldn't matter, right? It's not like we should really need large windows of liquidity, but it still is just the premise and the fact that there is restrictions on it. So is it semantics?
Mm-hmm.
Yes, likely. But at the end of the day, again, it's like even if maybe Bitcoin isn't better outside of semantically better, it's still definitely just as good as what a security in that sense might be, a stock or a bond.
Yeah. Yeah. Absolutely. I mean, well, you get some global event happen, some war start, over the weekend, and all of a sudden you're struggling to sell your stock and it's down 20%, over the weekend. I mean, it could happen. It
Okay, let's be honest here.
definitely
If
could.
that happens, Coinbase is going down for sure, which is where most people are going to sell that amount of Bitcoin. So I don't know if it's really, it might even be worse from that perspective. At least
Coin.
like those other businesses, they're just normally closed during those periods. And with Coinbase, you just got, it's like, oops, sorry, can't sell right now. Our bad, guys.
That's hilarious.
It's a truth.
Oh man. All right. Let's get next. Yeah, no, it is. It is to the upside too. Oh yes, something really good happens. Good luck.
Yeah.
You're not going to be able to sell on the upside either. Um, yeah. So all right. So the next one is less counterparty risks. So we've kind of already touched on a lot of these. But with real estate, I mean, the additional risks that we're not we haven't talked about, yet, I believe, are legislation risk. Obviously that one exists with Bitcoin, but as well. But you're talking about, you are subject to this county, state, laws, these local laws, on your real estate. If property taxes rise, or maybe they make a change to the laws, and all of a sudden your location turns into a bad location to own, your real estate's going to drop quite a bit. If you all of a sudden your city turns very liberal and they are a sanctuary city for illegals, that could tank your real estate values quite a bit. Obviously, that's bringing in our political views, but I think most Bitcoiners will share that sentiment of, you get poor leadership in a place, and it could really tank the desire for anyone to want to live there. And so, your real estate is subject to that specific area and the local laws and regulations of that area. So you're in a lot of potential bad scenarios that don't necessarily exist with Bitcoin, because it is a global asset. It's not tied to any one jurisdiction. So
And just to
anything
be
to add
clear
on that?
too, yeah, so again, we're talking about these assets within the scope of an irrevocable trust. So in that specific example, remember when we put assets into an irrevocable trust, we relinquish control, ownership, and benefit of those assets, right? So if we no longer have control or ownership of those assets, then what dictates if those assets or I should say, who dictates those assets when they might be sold, right? Well, it's going to be some sort of trustee, right? And yes, within the trust, you can put guidelines in and say, this or that about when assets might be sold or not be sold. But ultimately, it is someone else besides you who is making that decision. So in that specific example, we own real estate in a city, and now whether for whatever reason, the value of that real estate is significantly declining. Okay, now you no longer have say or control over what happens to that asset within the trust. Again, this is in general. Many people will say, well, no, you can still have some say so over it, but that's just, I guess, a letter of the law type thing. You can't say that. So now some trustee has to make that decision or not make that decision to actually do that. And again, this is to the benefit or detriment of whatever beneficiaries you've established in that trust. So in that scenario, right, that real estate starts tanking in value, and the trustee is just like, well, I guess we're just going to have to hold it because we're not going to get upside down in the property, or we don't want to sell it in a depressed market, even though maybe you would have done something differently. Maybe you would have actually sold this and done something differently with it. Okay, well, that's a sucky position to be in. And again, the premise behind that is it's not that that trustee doesn't have the discretion to actually do that. It's that there is, such minutia in what goes into that decision that they're likely not going to make the same decision that you are. Versus if we have Bitcoin in the irrevocable trust, you could just put in there like, all right, Bitcoin price reaches X, sell this amount or this percentage of whatever's in there, and then either distribute it to beneficiaries or just hold that in cash because you want it to be there, or hold it for reinvestment, whatever. Like the premise again is the difficulty in those decisions gets greater when there's more external factors upon them, versus Bitcoin, you basically just have price, which I know there's many things that kind of affect price across time, but that's really part of what that gets to there. And yeah, I mean, the counterparty one I think does get a little more difficult for me with Bitcoin, just because the likely way you're going to own Bitcoin in an irrevocable trust, there definitely is more counterparty risk than if you would just own it yourself. But by and large, that counterparty risk is still likely less than what every other asset is, or at least equal to it, right? If we talk about just, we keep going back to stocks just because those are an easy one. At the very least, that counterparty risk is the same because we have qualified custodians in the mix. I'd say the difference between stocks and Bitcoin in this sense is that, with a stock, if we just have one qualified custodian at Fidelity, we're kind of subject to whatever, whatever they say or do, subject to that specific counterparty risk. Versus with Bitcoin in this sense, if we're going to go to some sort of full custodial or even quasi custodial model, like a multi-institution, multi-sig, yes, there's counterparty risk, but that is still less because it's multiple institutions that we're really spreading that risk across, right? In a multi-institution, multi-sig versus a one specific entity like a Fidelity or like a Schwab type thing. So again, kind of in the weeds, or kind of semantics in some sense, but it is different.
Yeah, I mean, that's counterparty risk from the custody aspects. But if we just think about, a stock, you're owning Tesla stock. Okay, Elon goes out and does something stupid. Now your Tesla stock is screwed, which who knows, could happen. The point is, most companies that you could own, a significant amount of their stock, they're going to be subject to, again, regulations and laws of the place that they're doing business in. Their product may no longer be something that the market desires. Maybe we get the switch from gas vehicles to electric vehicles, and you owned a big, gas, diesel, whatever manufacturer, or something, a big stock, Ford or whatever. And now all of a sudden, that company is obsolete. Most of the large companies, that are in SP 500, whatever, the top companies that we see, they aren't the top forever. If we just go back 20 years, I don't know the exact, other companies that would be at the top, but I bet if you went back 20 years, the top 5 companies today would not be in the top 5, like they were, back then.
Mm-hmm.
And vice versa. The top 5 20 years ago would no longer be the top 5 now. And so, when we're thinking through this, it's like, well, Bitcoin is the total addressable market is every human on the planet. And it's not subject to any local laws, regulations, anything like that. So even, okay, one country becomes punitive towards Bitcoin. So what? There's hundreds of other countries that may decide that they don't want to be punitive toward Bitcoin. And then it doesn't hurt Bitcoin really at all that China decided to ban mining, or, the US maybe decided to hike capital gains rates to, crazy amounts. Would it change things in the short term? Sure. But again, there's not these potential risk vectors like there are with owning a single company stock, or anything like that. So, and we already touched on the real estate side of things. And so if we're just looking to, again, we're putting money into these long-term, structures to build generational wealth. And so we have to be able to look out into the future 50 years and say, what asset? I mean, you don't have to, you can obviously sell and buy something else. But again, we're thinking about what asset do we want to own for 50 years and make sure that my grandkids are set up for the most success that they can be. And if you ask yourself that question and you think through these different aspects, Bitcoin comes out on top every time. We don't know any of these companies are going to be around in 50 years. We don't know if that real estate building is going to be there in 50 years. Like, you just don't know. So, if you want to take as many risks off the table as possible, you hold Bitcoin. And that's how, people come to 100% allocation of Bitcoin in their own lives.
Actually,
But
all you're describing right now is game theory of Bitcoin. Like that is ultimately probably what a lot of this really gets to, is the long-term game theory of Bitcoin,
yeah.
right? Which is that Bitcoin as a better form of money that people are able to opt into. It's not a decreed money. Okay, over a long enough time period, the bullish case of the game theory is that people will make that choice. That choice makes Bitcoin more valuable, which makes it more valuable as an irrevocable trust asset and a more valuable asset in general. And then even, I suppose it's the game theory of, I mean, it's all of it, I suppose. And it's just amplifying, okay, what could Bitcoin become over the long term? And, I think we've talked about this on this before, but it really is where it's seemingly like we're kind of on the cusp of that game theory really starting to play out, from the standpoint of Bitcoin's kind of changing from the funny money speculative asset thing to no, there's legitimate use case, and there's legitimate entities that are I guess purporting or or maybe not using it, but adopting it because
Yeah.
of that legitimate use case. And so what you have is this just kind of legitimizing effect all around. And, once that's in play, that's when, again, some of these larger game theoretical things really start to take in full force. And those things don't stop over the next, cycle or the next 4 years, right? Those things are going to likely continue to play out for a long, long time. And so, yeah, it's just, I don't know why I started on that, but it is cool in a way, because in some sense it really is ultimately saying, hey, it really is, I suppose, putting your money where your mouth is, to put Bitcoin in an irrevocable trust structure. Because it really is saying, yeah, I really truly do believe in this asset. Because, you're saying, these other assets, who knows if this company is going to be around? Who knows if, a hurricane won't wipe out this real estate? Who knows, XYZ? We don't know
Yeah.
with Bitcoin either, right? Like, and many people would argue that we know even less with Bitcoin than we do with these other things. I think there's probably good arguments for that, but there's a lot of good arguments against that. And that's kind of what I'm getting to is, yeah, we don't know, but we do know that if Bitcoin plays out in any sense of that total addressable market, if adoption is price, and we're starting to see we're continuing to see broader adoption, we're continuing to see adoption by more legitimized entities and institutions, all of a sudden we start to see this kind of not the light bulb, but the wow factor, I suppose, of Bitcoin coming out.
Yeah. Yeah, I mean, you're spot on. I mean, essentially what we're going through is why Bitcoin? Why Bitcoin over that real rental property? Why Bitcoin over gold? Why Bitcoin over that stock? Why Bitcoin over bonds? That's essentially what we're running through here. And that's why we get potential nation state adoption, even further. We have a couple, but they're small. Corporate adoption, everything else. They're doing the same thing. They're looking at, okay, why Bitcoin over everything else? And they're coming to the same conclusion. And that's why they're deciding to adopt. And that's why, every Bitcoiner has decided to adopt to the extent that they have. Because when you start to just look at these trade-offs of why Bitcoin instead of that, it's hard to justify owning anything else on a long enough time horizon. And so, yeah, I mean that you're spot on, and that's exactly what we're describing here. And that's why I preface with this at the beginning with, it's really the same reasons of why Bitcoin is the apex asset to own outside of an irrevocable trust. It's the same reasons within a irrevocable trust.
Look, all we're
Except with
trying to do
this,
here,
we're
all
trying
we're
to
trying
avoid a
to do,
40% haircut.
yes, right. All I was going to say is all we're trying to do is create a whole bunch of Bitcoin trust fund babies. That's all we're trying to purport here. Just make as many Bitcoin trust fund babies as we can.
100%, 100%. It's fun to think through this because again, this ties back to kind of why are we in business? We are in business because we believe that Bitcoin changes every single area of somebody's financial plan. When we're talking to a prospect, we're showing them, okay, we're going to go through your estate plan. We're going to go through your retirement plan, your tax planning, your risk management and insurance. We're going to go through everything, and Bitcoin touches every single one of these areas. And so it's fun for us to sit in both camps of we're Bitcoiners and we're also financial planners to see how does Bitcoin come into the traditional financial world and change things. And this is one great example that's fun to think through of like, wow, okay. Bitcoin is the best asset to own in a irrevocable trust. And we just didn't have that option before. It was always it was a stock, a bond, or a real estate property, a business, art, whatever. And now it's like, wow, Bitcoin just improves, or at least is tied for first again in every single one of these properties or these areas that we think about. And so it's fun.
Mm-hmm. Yep. And then hopefully Bitcoin just becomes actual money, and what everything's denominated. It becomes the unit of account in the future, and then we don't even need to worry about irrevocable trust structures anymore. So that'd be super cool, because part of me, like, irrevocable trust structures are
Yeah.
great and everything, but part of me sees irrevocable trust structures as just part of the end game of fiat. I mean, that's all it really is. So we have these fancy mechanisms for avoiding
Yeah.
tax because, like, again, the majority reason why we have tax avoidance in the first place is because we have a depreciating money. We have money that is losing value over time. So we use other assets to store that value. And we want to be able to store that value in its fullest because, again, what we're basically, I suppose, well, we should have showed those charts, but like just even the premise of M2 versus the S&P over the last 60 or 80 years, right? It's like you look back at that and they're basically the same. Okay, so all this appreciation that's happened in stocks, same thing with gold, same thing with home prices. All this appreciation is just due to more money being in the system. So again, we have all these fancy mechanisms because what we're saying is by taking these tax haircuts, this estate tax haircut, is you're effectively still diluting the value of the work that we originally what that a work was originally done to acquire those assets, right? Everybody likes to talk about, the rich and blah blah this and that. I'm not saying that people don't take advantage or that there's not bad practices that are done by people who have wealth. I'm not trying to say that at all. But what I am trying to say is at the end of the day, that's why these strategies have to come in place, because at the end of the day, the money was earned at some point, right? The value was created at some point, and that value, by putting it in these various assets, is pretty much only kept up with debasement across time. And so by trying to avoid taxes, we're just trying to say, hey, we're trying to make this so we're, not debasement net negative. We're at least keeping up with debasement even across our lifetime. So at any rate, I started that rant with, I would love to see irrevocable trust structures abolished. is what that started.
Yeah. And that, it's a good point too of, what we've talked about. There's a lot of Bitcoiners that will say that financial planners are no longer necessary on a Bitcoin standard, right? And, obviously we can see that future too. And that's what you're speaking to right now. But the reality is we're not there yet. We're just not. And so our value in working with us is, we're in a fiat denominated world still where Bitcoin exists. And so we have to blend these two worlds with where we currently stand. If you do not want to blend these two worlds, fine, pay 40% on your Bitcoin to the IRS. Go ahead. If you want to, go right ahead. Like if you want your grandkids to receive half the amount of Bitcoin that you've accumulated, fair enough. And so I mean, you're chuckling, but it's just like we're not there yet. It just there's just a lot of the Bitcoin world that's kind of delusioned a little bit, that thinking that we're already there. We're already living in a Bitcoin standard world. Okay, maybe you are, and in your mind, but the IRS isn't. Like, let's just be honest. So yeah, that's important to look there. And so that's why us being Bitcoiners, we can confidently still say we believe that it is best to still work with a financial planner. We can say that we truly have your best interests in mind. We're not these normies who are just seeing Bitcoin as, oh, these are potential wealthy clients that we can bring on. Like that's not where we're viewing this from. It's truly, no, we're going to help Bitcoiners navigate the current system and structure that we're in until we can get to the end game, the end world that we see is possible. And so we're going to help Bitcoiners hold on to and secure and get to their kids and grandkids, much of the Bitcoin that they were able to stack over their lifetime, which is exactly what we're speaking to here. And that's why we can do that with a clear conscience and a clear heart, because we truly are doing what's best in offering this service. And it is truly a service that is needed at this point in time. Will it be needed in the future? Who knows? But it is right now.
We even hope it's not. Like that even before Bitcoin. Like, no, I mean, seriously, like before Bitcoin, it really was. It was like, I honestly hate that we have a job doing what we're doing in some respects. Like, because what it gets to is our system, our financial system, personal finances and more broadly taxes, whatever, is so freaking convoluted that you need to have somebody to step in. Like, we shouldn't have to have that. We shouldn't have to waste brain cells on this stuff. Like we should just be able to, hey, save our money, right, and maintain our value. And if we want to take more risk and go into more, other different ventures, okay, maybe then we can pay somebody to help us. But on some respects, it's just like we shouldn't have a job, but we do, because again, it's a system we live in, and we're going to continue to live in that system for probably the rest of our lives. It's probably not changing by any respect. So hopefully I didn't cut out there. I saw my little thing say it's trying to reconnect, but anyways, rant over.
It's all good. I heard you, so I'm sure it'll come through. Yeah, so we'll get off that. That's maybe another conversation we can have in the future of why we're even necessary still at this point in time, despite the delusion and the among some of the laser eyes on Twitter. So last couple things I'll just briefly mention because I know we're getting pretty long here. Again, you can go read this on our website. We wrote a blog about all this, so if we've lost you along the way, you can go check this out. But the last couple things are appreciation potential, which we've really already talked to in many ways. Of Bitcoin can appreciate in value, against the dollar very significantly over long periods of time, and so that's why you should even be thinking about this in the first place. And why you have the incentive to try to avoid this 40% tax, because 40% on $100, $40, okay, but if we start getting $40 million, $50 million worth of Bitcoin, which could easily happen for somebody who even owns $1 million worth right now. I mean, we get 20 years, 30 years down the road, we could easily be there. And so that's why you want to start thinking about this, and why, Bitcoin, again, is the kind of king of assets to hold, is we're able to avoid the most tax holding it within this structure, an irrevocable trust structure. And then the last point is just global accessibility, security, and censorship resistance. So, global accessibility being anywhere in the world, we can get this asset to our beneficiaries, or they can benefit from this asset. If they cannot pick up their apartment building and move it to another country, if the United States starts to have, unfavorable laws, or the United States goes to crap, whatever, you can't pick it up and move it. But with Bitcoin, you can. You're not, again, subject to that. And if you have, maybe your beneficiary at the time is a missionary in another country, all right, well, we can easily get that asset to them without having to worry about any problems along the way, or even liquidating it. Security, any Bitcoiners listening to this, would know what we're talking about with security. It's a lot easier to secure your Bitcoin than it is to secure the gold in a, vault somewhere, or, protect your building in a downtown, city where riots are going on or something, that's just another consideration. And then censorship resistance, we've touched on that in other conversations, and it's pretty straightforward of, Bitcoin allows you to do what you want, when you want, wherever you want. And that's why, again, it comes out on top versus other assets. So anything else you think would be good to just kind of put a exclamation point on this before we wrap up?
Yeah, I mean, I think just to kind of reiterate some of the fundamental things of what we're talking about here, the reason Bitcoin is a good asset for an irrevocable trust is the same reason that we hold Bitcoin in the first place. The only difference is that because of the fun games of our financial system, there's a potential way that you're going to owe 40% tax, or not you, but your estate's going to owe 40% taxes on the amount of Bitcoin that you've accumulated. And so if you've accumulated a large amount of Bitcoin, or you think that that appreciation of the Bitcoin you accumulated is going to be great into the future, we have a strategy or a way to avoid those 40% taxes, then we should at least consider taking advantage of that. Of that strategy. But fundamentally, the reason that it's a good asset for these structures is because it's a good asset in and of itself, and it's a good asset in and of itself because of all the functions that we've discussed in previous episodes. So this is really just an exploration of, some of these more, I would say, bespoke strategies that, again, to what we're kind of saying at the end here, even if you're a Bitcoiner that doesn't think that you need this stuff, that you're just going to give your keys to your kids, upon your death, and you're not going to worry about estate taxes or whatever. Well, all you're just doing for them is putting a bigger target on their back for future problems down the road. And so if we can avoid that, and we can avoid those taxes in the first place, then let's do that. And if you don't think that's necessary, that's fine. But at some point along the Bitcoin journey, especially as we always say, if Bitcoin continues to do what we think it can do, my guess is you'll change your tune. And we've seen that, multiple times just in our own experience. The Bitcoiner kind of changing their tune to people like us, especially in the way we're working. So if you're trying to go to a whole life salesman and get the service, I can agree with you there, but not in the model in which we're doing it.
Yeah, totally. Yeah, 100%. I mean, if you are above this estate tax exemption limit and you're just passing the keys to your grandkids, kids, whatever, you're committing tax fraud. And, like you're saying, you're putting that target on your kids' back now, on your grandkids' back. Now they have committed a crime, basically by having these assets without paying the tax on them. Whereas, we have an avenue to do this legally. Let's just do it legally so they don't have to worry about it into the future. They can go ahead and use the Bitcoin freely without having to, think in the back of their mind if, they're going to end up in prison for doing it.
And maybe the last part.
All right. Well,
real quick.
Appreciate you.
The last part, the only thing I'd say is, okay, the irrevocable trust, it still just bothers you maybe from a privacy perspective because of some of the, custody aspects that we've talked about. Like, an irrevocable trust is not the only solution to this problem. It's probably the best solution, but it's not the only solution to the problem. The problem being the 40% haircut of estate taxes. There is other potential solutions, but those all have other trade-offs with them that, I don't know, maybe we talk about in the future, maybe we don't. But it's not the only one either.
Right. Absolutely. Cool. Well, I appreciate you listening all the way through, and we'll go through the cons in more depth, like the custody aspects that you're referring to. We'll get into those in the next one. But thank you for listening all the way through. If you have any questions, feel free to drop a comment or reach out to us, send us an email. Or if you're interested in exploring how we can help you with this stuff, go to our website, strongwealth.net, and you can schedule a free discovery call there, and we can get to know your situation and see if there's anything we can do to help or not. So thanks for listening. Share with anybody if you feel like it'd be valuable for them, and we'll see you in the next one.